Crypto's not the Wild West anymore, folks. It's got a sheriff. Two, actually. And their names are MiCA and AMLR. First, a disclaimer. This video is for informational purposes only and does not constitute legal advice. Consult our team or another qualified professional for personalized guidance. Greetings all. My name is Robert and I'm a legal consultant, licensed tax advisor, and the founder of Kyroptera Consulting, a legal office based in Slovenia. With our deep expertise in crypto law, international trade law, tax law, and AI-based SaaS law, we've helped dozens of businesses wrangle the complex world of legal compliance. So buckle up. Let's dive into how the EU's taming the crypto frontier with AML and CFT rules. Imagine you're in Berlin, sending 2,000 euros worth of Bitcoin to a friend. Sounds simple, right? But behind the scenes, the EU's got your back, making sure that the transaction isn't funding anything shady. Today, we're breaking down the EU's anti-money laundering AML and countering the financing of terrorism CFT rules under MiCA and AMLR. Two regulations that are making crypto safer without locking up your freedom to hold your own coins. So, what's AMLR? Think of it as the EU's financial crime-fighting superhero. The Anti-Money Laundering Regulation, or AMLR for short, lays down uniform rules to stop money laundering and terrorist financing across the EU. It's like telling crypto exchanges, hey, you're not just a cool app, you're now an obliged entity like a bank. That means crypto asset service providers, or CASPs, think exchanges or custodians, have to verify your identity and keep an eye out for anything fishy. Under AMLR's Article 79, credit institutions, financial institutions, and crypto asset service providers are banned from offering or maintaining anonymous accounts, including bank, payments, passbooks, safe deposit boxes, or crypto accounts, or any services that anonymize customers' identity or obfuscate transactions, such as through privacy-enhancing cryptocurrencies. This targets platforms that might enable hidden transactions, yet it explicitly does not restrict self-hosted wallets. Those you control yourself, like hardware devices. As one of the most common issues faced by the EU, transactions with personal wallets are taken into account in risk assessments, but personal control over funds remains legal. This preserves innovation while enhancing security. So, what does this mean for you? Expect to show some ID when signing up for an exchange, think passport or driver's license. Keep records of your transactions because they might get a closer look. And stick to reputable platforms that play by the EU's MiCA and AMLR rules. Trust me, it's worth it to stay on the right side of the law. Now, let's talk about how MiCA and AMLR team up. Like a regulatory Batman and Robin, MiCA, or Markets in Crypto Assets Regulation, is all about making crypto markets legit. Think consumer protection and market stability. AMLR swoops in to add a layer of security, ensuring CASPs have systems to spot financial crimes. Together, they're building a single rulebook that says, crypto, you're welcome in the EU, but play nice. MiCA makes sure CASPs are authorized and their management passes a fit and proper test, no shady characters allowed. AMLR then mandates KYC checks and internal controls to keep things squeaky clean. The best part, this deal doesn't mess with your self-custody wallets. You can still control your own crypto, no sheriff needed. Are you planning a crypto trade over 1,000 euros? Hold up, you'll need to flash some ID. AMLR's Article 19 states that any transaction at or above €1,000 triggers full Know Your Customer or KYC checks. It's like showing your passport at a bank, but digital. So what's the goal? Making sure your trade isn't funding anything dodgy. For smaller transactions, lighter checks apply. But if you're dealing with high-risk countries, expect extra scrutiny. Here's how to stay compliant. Submit your ID promptly. Explain where your funds are coming from, if asked, and use two-factor authentication to keep your account secure. It's all about keeping the crypto space safe, without cramping your style. What happens if a transaction raises a red flag? CASPs are on the hook to report it to the Financial Intelligence Unit, or FIU, no matter the amount. Article 69 of AMLR states they've got to act fast, sometimes within 24 hours in urgent cases. This helps the EU crack down on money laundering or terrorism financing. Even transfers to self-hosted wallets get extra checks. But don't worry, your personal wallet is still yours. Want to avoid those red flags? Use transparent fund sources. Report any mistakes quickly and keep an eye on high-risk country lists. It's like keeping your crypto passport clean. So, there you have it. MiCA and AMLR are the EU's way of making crypto safer while keeping innovation alive. They're balancing security with freedom, ensuring your transactions are legit without banning self-custody. As these rules evolve, stay sharp and check official EU texts to keep compliant. What about the future? A crypto space that's secure, trusted, and ready for growth. If you found this video useful, please consider giving it a like, sharing it with your network, and subscribing for more similar content. For more legal insights, check out our Knowledge Center via the link in the description below. Thank you so much for watching, and remember, compliance with the law prevents the flaw.